Hey everybody, it's Chris Kirkpatrick with Life 180 back here in the Better Wealth studios with my buddy Caleb with Better Wealth. And I'm really excited. I think this is probably, if I seem giddy, it's probably one of the most excited videos that I've filmed in a long time because I think one of the most common questions that I get is, or statements, or I guess pushbacks that I get from people is, that is great, but why would I put my money somewhere that regardless isn't going to break even till year 7, right? Like it doesn't always have to be exactly that. I'm just using generic kind of like situations. But the bottom line is people just are kind of missing the boat when they come at it from the internal rate of return of the policy in that time frame, right? They're not looking at the long-term perspective, and they're also not looking at what they can do with the capital that they do have access to in the meantime.
100%.
Right?
100%. Yep.
So Caleb, before we get into this, I want you to talk a little bit about the structure of the policy because we worked on building this together.
Right.
And what I did, guys, is, well, Caleb and I did this, is we built a spreadsheet. And so actually, I'm going to try to zoom in just a little bit. There we go. That'll make it a little nicer for everybody. And so what we've done is we've built this spreadsheet, and I want Caleb to go through and explain kind of the structure of the policy. So well, you do it.
And basically, there's 3 types of ways to structure life insurance. There's a term way, which we're not talking about, that doesn't build cash value. And then when you're building cash value, there's something that we call a cash flow strategy, where you're taking the same amount of money each year and putting it in. And that's where you can get, creative. But one of our favorite types of funding strategies as relates to working with real estate professionals and entrepreneurs is doing what we call the front loaded strategy, where we're taking a large sum of money up front, putting it in, making it cash rich, and just allowing the policy, number 1, to have more money growing, but number 2, creating more flexibility and to give you just a lot of options. So you'll see, if we go back to this, that in this policy, what we did for you, Chris, is we put $100,000 in first year, and then giving you the ability to put up to $20,000 every year after that with a smaller base. So this is a very flexible plan, and I'm going to turn it over to you, but I want you to know that this plan we do a lot for real estate professionals. And
so I love this, everybody, because this is exactly the plan that I would suggest anybody who's looking for long-term potential in the policy, and as well as enough liquidity to get your flexibility to get your real estate, or it doesn't have to be real estate. I'm using real estate as the example here, and I'll explain the variables. But if you watch a lot of our content, you see I do a lot of cash flow real estate videos with Mike Wolf, and this is kind of speaking to the numbers in one of the programs and properties that Mike offers through his system in Atlanta, Georgia. So I'm just kind of using those numbers in one of the properties. And so these aren't like set in stone numbers, but they're just meant to be an example to show the power of this. So let's get into this. So you can see just in column 1 here, you can see that there's an initial dump in, as Caleb said, of 100,000. So out of that, the year 1 liquidity is 88,000. So in fairness, I'm going to say a lot of people that don't like this will say that, hey, I'm losing 12,000. Well, there's a cost of insurance, right? We don't show up. There's about a $1.7 million death benefit on this thing for a 35-year-old, is it? Or whatever. So that comes into play. But the 88% liquidity, when you look at the fact that all the benefits you're getting, a guaranteed 4% growth and just everything else that comes with it. Anything else on the guaranteed that you want?
No.
Okay. So then you're putting $20,000 a year in. So year 2, you go through, you put $20,000 in. So now we've put 120 in. We got 103 available, right? Year 3, we put another 20 in. We put 140 in, and we got, we also took, now that year, we took a $100,000 loan against the policy to get a real estate property, right?
And so I'll just point one note before. This balance right here at the T, that is the cash value, and that's what your interest and dividends are earning. And you'll notice that, yes, the disadvantage to life insurance is the first couple of years you don't have dollar for dollar access. But this is the engine that's growing regardless. And regardless of the loans or whatever, we see in the next column, you're going to see the difference when you take loans, the cash available. But your dividends and interest are earning on the full cash even though you don't necessarily have all that available if you take a loan. I just wanted to point that out.
Well, and to point this out as well, even though you did a $100,000 dump in and you lost 12% there, or roughly, the next year you put in, you're still a little behind on cash in, cash out that year. But the following year you put another 20 in. Check it out, you actually make 2,000 more. Right. So you're really only putting cash in on a negative, quote unquote, basis for the first 2 years.
And you'll see over 30 years, you'll see why it makes, it's a no-brainer to make this happen.
So even though people say you're really going 7 years investing in a lot of situations, you're really, the first 2 years, you're basically investing for the long-term strategy. Plus you have liquidity and access to that capital, which I'm going to show you right now. You're going to more than make up for what you lost, right? Or what you didn't have access to because you didn't really lose it. And year 3 on, you put 20,000 in, you see there's a jump by 22,000. Year 3 to 4, you put 20,000 in, you see there's a jump by 25,000. So like that's pretty darn good, right? Just to make that clear for everybody. So getting back to the point of this video though, you take $100,000. So I'm talking about buying a $100,000 property in Atlanta, and with that, there is a cost to pay that loan back. So we are taking all the cash flow out of that property. So you can see there's $100,000 here in column L, and then the real estate value is worth $100,000 because that's what we just bought it for. Now there is a loan repayment after you buy it for that year of $15,472. Now that is the base of the loan plus 5% because there is a cost to borrow, right? So that cost to borrow gets it to $15,472 a year.
The point I want to make is we're assuming a 5% loan interest, and this is very common with a lot of carriers that we work with. Some carriers are even cheaper, but I just wanted to round up.
We're trying to be conservative.
I mean,
ultimately, and I feel like I'm trying to be even more conservative when it comes to real estate appreciation and all the variables that kind of come into play here. And I'll get into more of those. But you can see as you go down here, mind you, this is only for one property, right? This is using this strategy one time. And you can see here that $123,000. Now we bought the house for $100,000, so that means our net cost to borrow was $23,776. So we had an interest expense over the 8 years it took to pay this loan back to the policy, to the insurance company. It cost just over $23,000.
And a common pushback is, why would I borrow to use my own money? Which is incorrect, because you're not using your money. Your money's growing. But it is something that people have a hard time wrapping their head around.
So here's the answer to that. So it cost you $23,776, but here's the deal: you borrowed $100,000 to get it, and if the house appreciates at 5%, now that house is worth $40,000. So the difference is the $40,000 more. It's worth $140,000. So the difference is the $40,710 minus this $23,776.
Well, and this is where this is a dialogue. Actually, what I would say is I would just slowly look at the cash value over a long period of time, because you could, with cash, you could take that $100,000 and pay cash for that real estate and still get all the benefits, but you wouldn't have your cash value growing a tax-free engine at the same
100%,
time.
100%.
So that's how the difference would be.
Right, and so now what's happening here, though, is that because you did this, I mean, your cash has gone up. You're fully liquid now, because you can see column T, the dark purple, and then the blue. This is the cash value. This is like how much is actually growing and compounding for you, as Caleb said. And this is the collateral capacity, as we call it. This is your net money available, right? So you can see here in year 5, even though we borrowed against it to get the property, there'd be enough money in year 5 to buy another property, right? So the example we're showing, to keep it real simple, is just showing one property and what that property can do to increase your net wealth potential with just doing it one time, right? Compared to just, it's showing that comparing this to keeping it in a bank account versus doing this, and it's not about rate of return. We always say whole life is not a place to invest your money. It's a place to store your money and then invest in things that you understand. Invest in things that will get you the returns when you're in control of the results, or more in control in determining the results. And so the house here, you can see, is down to 140. Now here's the cool part. This is where it gets really special, in my opinion. Now that the house is paid off, right? So now you have this asset worth $140,000 on top of the $330,000 that's in the policy. So you got the asset that's worth $140,000 that keeps going up. I just have a simple 5% increase every year. I think it'd probably be more than that. But the cool part is after that, the house is paid off and you have $15,472 a year in cash flow added to everything. That's an extra $309,000 in cash flow. Now, I didn't illustrate this. I didn't show this in the spreadsheet. But guys, this is not taking into consideration inflation for rent.
Right.
Now, if you're a real estate person, you understand that from day one here, and we're not illustrating it in this even for loan payback, you're going to build in clauses that have like 2 to 3% rental increases on a year-to-year basis on your lease. And so that's all going to be, like, all these numbers are going to be way better than I'm even showing you. And what I'm showing you is pretty darn amazing. Like what this shows is that you've got 1.5 million in cash value in the policy, right? How much have you put in here? I didn't do this. Equals sum. Let's do that. You put 680 in. You have 1.5 million. What did we say? This is like a 4%, or whatever.
4%.
This is a 4.05%.
The point that I want to make is that is the real benefit of using life insurance, because obviously there's benefits of real estate. Obviously there's benefits of cash flow. I would make the argument that your money grew to 1.5 million in this policy and gave you the ability to do real estate and cash flow, and that combined, that's worth paying an extra, let's just round up, $24,000 of interest to create an activity that's going to change your life for the rest of your life and allow your money to continue to grow. Like that's so the powerful difference, and I'm impressed what you've done here. I like the math.
It's awesome, man. I love it, man. This is stuff that I live for, because I mean, this is what it doesn't matter. Once again, it doesn't matter. This could be a business. We could change real estate to business, and if your business just grows at a measly 5%, right? Like that's on top of when he says the and asset, like. I feel like it's a hard point to get across on a video.
I know.
And I've been trying. He's been trying. And I feel like this is the closest I'm going to be able to get right now to be able to illustrate what we mean by and, because it's not the investment. The insurance policy, you hear us say, if you watch all of our videos, you hear us say the insurance policy is not the investment, and this is what we're talking about. The investment is what you decide to do with the money. And in this situation, we use real estate. But here's the point. We got an extra $273,000 because you can see at 5% a year of growth in that property, it grows to $373,000, but you minus out the purchase price. That's a net gain of $273,000 to your net worth compared to what you started with, right? And you have a $309,000 extra positive cash flow during those 30 years. All in all, that doesn't include any inflation or anything with any of this, with tax benefits, no nothing. So we're like, this is so much better than I'm even showing you, and it's an extra, let's say, close to $600,000 on top of the 1.5 million. So if you take in the rate of return, not in the policy, but in the strategy, come on, it doesn't get better than that. And I don't know how to explain it. If you look at these numbers and that doesn't make sense to you, please make a comment below. Yeah. Please, I want to be able to try to make this make sense. I know some people are like, oh, you and your voodoo math and whatever. There's nothing voodoo about this. This is as straightforward as it gets. And, I'm actually thinking about a specific comment that a guy made last week, and that's what inspired me to make this video. So when I say you make a comment and I'll make a video, this is what I'm talking about. This is... I do a lot of coaching for entrepreneurs, real estate investors. My wife is a real estate agent. We buy flips. We fix and flip homes. We buy investment properties. This is what we do. I just bought my trailer. If you do this with buying any kind of major capital purchase, if you can monetize it and you can create a rate of return in it, this is what it's all about.
I just did a video on my YouTube channel about how I'm purchasing an airplane using this strategy.
Really?
It's just
awesome.
It really is. The opportunities are infinite.
Are you getting your pilot's license?
Well, that's a whole nother episode. That's a whole nother. But it's the really what you use your money is not the issue. Obviously, if you want to make wealth, yes, you want to use your money on things that are powerful. But you want to make sure that you can maintain full control.
Amen. I love it. So. That's it. You have anything else you want to say about this?
No, I think we've hammered it. And we're going to have more videos.
Do you get the point?
But
I love this stuff, and I think if you have any questions, make a comment below. Please, if you love this, if you think you have somebody that needs to see this video, subscribe, hit the bell. That way you get notified. We got a ton of videos coming out. And make sure you share this with people. I cannot tell you how much appreciation I would have for you to share this video, because I'm on a mission. I know Caleb's on a mission to get this information out there, because there is such a lack of education when it comes to the financial literacy around the different types of financial products that are involved. And I'm kind of tired of it. So here we go. So go out there, crush it. Have a blessed, inspirational day. I'm going to quit rambling now. Talk to you soon. See ya.